And welcome to the latest monthly market update from Zurich Life. I'm Jacqueline, and I'm very happy to be joined by our Head of Investment Solutions at Zurich, Ian Slattery. Good morning, Ian.
Good morning, Jacqueline.
Thanks so much for being here today, just to discuss what's happened in markets up until the date of recording, which is Tuesday, the 12th of August, how this has affected different asset classes, and what this might mean for you as an investor. Today, we'll take our usual format, and I'll be addressing some of the latest frequently asked questions in a rapid fire round. So, Ian, to start, we'll look at the big picture. July provided a complex backdrop with diverging economic signals and renewed geopolitical developments. Could you go through which signals were diverging and what market events most impacted investor sentiment?
Yes, thank you. So, look, July has been a busy month, as they always are for investment markets. So, just starting as we usually do in terms of looking at the main asset classes. So, what I'm showing you here in the blue line is the global equity market for the year through to the end of July, and in the beige line, the equivalent statistic for government bonds in Europe. And it's interesting to see if you'd gone away for the first 7 months of the year, you would have thought not much had happened with both the returns for global equities and global bonds in touching distance of that 0% point. If we talk about the main things that we saw throughout the month of July, July was a positive month for equities and a flat enough month for Eurozone government bonds. To answer your question, we had trade tariff tensions and talks being the main topic of conversation once again in July. We saw the European Union strike a late trade deal with the US, which helped bring global equities back into positive territory for the year to date in euro terms. In relation to fixed income, the big news stories were from the ECB and the Federal Reserve both keeping rates on hold at the levels they were at before. So a little bit of a pause from the ECB, and we've not yet seen the Federal Reserve implement or initiate any cuts so far. But overall, a positive month for equities, a bit of a flat month for bonds, and we see both of the main asset classes broadly back where they started for the year to date. Just to speak slightly on the tariff piece, and I know we've had many of these videos recently, Jacqueline, where we can't kind of get away from this particular topic, but what we're showing you here is the reciprocal tariff that was announced on or around the start of April, that Liberation Day. The middle column is just have we seen an agreement since, and then the right-hand side column is the current tariff applicable for various countries and monetary unions. I think the only thing I'll take away from this is, or for this particular juncture, is just focusing on that middle column. We have a fair mix of both yes and no. So we've seen some big tariff deals announced. I've already referenced the EU, but we've also seen the likes of the UK. However, we see the likes of China has had another 90-day extension, and some other key areas haven't seen trade tariff deals as quickly as they might have expected. So we do expect this to be the key narrative for markets, much the same as what we've seen in 2025 so far.
Yeah, you've raised a key consideration. Speaking about geopolitical developments in general, it was a busy month and several new agreements were struck, and this has seemed to ease fears of an outright trade war. What were the most significant of these agreements, and can you just talk us through how that's affected the market?
Yeah, so we saw in late July the president of the European Commission, Ursula von der Leyen, meet President Trump at one of his golf courses in Scotland and strike a deal. A little bit underwhelming has been the initial reaction from European leaders. They feel that the US have got the better of the EU in this particular deal. But as we've often spoken about, at least there's certainty there for European businesses and therefore European equities in terms of those listed businesses. So maybe not the deal some people may have hoped in the initial onset of the talks, but it has been a positive for just from the mere certainty of it.
Yeah, and staying with equities, looking at them on a regional level, we've shifted to a neutral stance in both Europe and Japan. What market dynamics specifically drove those regional shifts in July?
So if we just look at the global market, and as you said, we split them across some of these main regions that we look at, and also included the likes of Ireland, just for local listeners. And I think it's clear to see that we look at the US and the green. It's still very much the laggard of the major areas, whilst the likes of Europe, in the dark blue has done quite well, as has Europe ex UK, so non-eurozone as well within the European region. So I think that idea of divergence at a regional geographical level is a narrative that's been very strong in 2025. And as an active manager, we try and play on some of those narratives. And that volatility or that divergence gives us opportunities. So as you've mentioned there, in the last couple of months, we have had a preference for Europe and Japan. We've scaled that back a little bit and put some of that money to work, excuse me, in the Asia Pacific region. I think it's always worth noting, whilst we're a little bit cautious on the US, it's still by far the biggest market. And we do feel that strong earnings and strong local economic growth stories in the Asia Pacific region can help the equities in that particular geography outperform in the next little while.
Yeah, and staying on the broad theme of opportunities with on a sector basis in equities, we saw information technology and energy sectors were the top performers in July. So can you just talk to us a little bit about what drove these strong returns?
Yeah, in one word for tech, it's been earnings. So those big Magnificent Seven companies that we talk about quite a lot, some of them had underlying strong earnings. So the end of Q2 earnings that were released throughout the month of July. It's interesting, as you state there, the likes of tech and energy were really, really strong in July. But if we actually just step back slightly and look at the year to date figure, they're not the best performers so far. So we still have that idea of rotation. Some of the companies on the left hand side, like that are in the utilities and the financial sectors, they've been strong for the year so far. While tech has definitely been a pre and post Liberation Day story. So the rebound in some of the earnings and the growth prospects of those Magnificent Seven companies has fed through into the information technology sector, which in turn has helped the US stock market as a whole. But earnings and I suppose the underlying positivity in terms of the potential business prospects for some of those bigger tech companies, including artificial intelligence, AI, again, one of those key narratives over the last 12 to 18 months, has led those stocks higher over the summer.
And moving on to fixed income as an asset class, the big beautiful bill was signed by President Trump, and it seems to have increased market anxiety due to the potential impact on the US deficit. How does this feed through to our thinking on the Eurozone government bond portfolio?
Yeah, so it's the way to look at it there, I suppose, is we are very much Eurozone government bond investors. However, what happens in the US, like in other asset classes, feeds through to our thinking here. So what we're showing you here is the yields for the German 10-year bond for the year 2025 so far. So as this line goes up, prices go down. So you can see a little bit of volatility early in the year, but a relatively flat story across the month of July. To answer one of your earlier questions, yes, we do see the specter of increased fiscal spending and increased debt in the US. It is there across the market. However, it's something that we're very cognizant into the medium term, but doesn't keep us on the sidelines of bond investing at the moment. And I think it's really worth noting, if we look at where yields are now, just using this particular chart, you can pick up that 2.7, 2.6% every year in terms of your coupon. And I think that's really, really positive environment for multi-asset investors, that there's many levers you can pull. We can have opportunities within equities, and we can also have opportunities within the Eurozone government bond market. So the idea of fiscal reform has been a big thing for Europe this year, but we have seen rates move lower as well, and that's positive for bonds as an asset class.
Yeah, that leads me nicely into our next question. Looking at our own multi-asset portfolios, we're currently slightly underweight equities and overweight bonds, so we have a modestly short duration. What's the rationale behind this, particularly for the duration on bonds?
Yeah, so we might come back and explain duration a little bit more later on, but I suppose just for right now, what that means is that we're trying to reduce our exposure or our sensitivity to changes in interest rate expectations. So why are we doing that? We feel that the path for lower interest rates has been strong in the first half of 2025. It's going to be a little bit more unsure in the second half of 2025. So we want to just reduce our exposure to changes in those expectations. So the idea being short duration is you reduce your exposure to those interest rate expectations. So that's the position for us within the government bond portfolios at the moment.
Okay, that's a good point. So turning to commodities and currencies, within commodities, oil prices rose due to global tensions, while gold, which is typically known as a safe haven asset class, retreated late in the month. So why did gold fall when geopolitical risks were high? It's a little different to what we've seen historically.
Yeah, it's a good point. It's a bit of a contradiction, right, in terms of the theory that we all hear, I suppose. But again, if we kind of just zoom out slightly for the year to date, I think gold, as represented by the gold coloured line here, has been on a strong run in euro terms. I suppose if we think about equities being stronger across the month of July, that's a bit more of a risk-on sentiment, a bit more optimism out there. That'll impact gold, I suppose. It doesn't have that safe haven status just at the moment, and there's a little bit of a pause for breath as well, right? So you see gold up over 10, nearly 15% for the first 4 or 5 months of the year, and it's traded sideways since then. So again, after a strong 24, perhaps a bit of a pause for breath in the middle third of 2025. You've quite rightly pointed out that we see oil volatility on the back of geopolitical tensions. That just hasn't spilled over outside of commodity prices. So the continued tensions in Ukraine following the Russian invasion, we might see more on that in terms of meetings in the coming weeks. And indeed, what we still continue to see in the Middle East. A lot of that geopolitical tension hasn't spilled over into main asset classes and has been confined to the strict supply and demand parameters, if I could put it that way, of the oil market.
Okay, and looking at currencies now, more specifically, Zurich recently increased short-term USD bond holdings, taking advantage of negative sentiment towards the dollar. But it's also positioned for some dollar strength. So can you talk us through the strategy? Was it a contrarian move, and how has it worked out so far?
Yeah, so we're just pulling up the euro US dollar exchange rate chart through to the end of July. So again, as this line goes up, that's the euro strengthening. So you get more US dollars for your €1. So you've gone from just under 104 up to a high of 118, and a bit of a retrenchment, or at the very right hand side, that's US dollar strength. So from a technical perspective, it was a little bit of a contrarian move. There's a lot of people and market participants thinking that the US dollar was going to continue to weaken. So we thought that we might see a little bit of a reversal in that in the short term, and that has materialized. Now it's the euro has strengthened in the last week or so as well, and it has been very volatile, particularly with the trade negotiations. But currency hedging, currency movements, they're such a large part of investing, particularly with the dominance of US dollar assets in the equity market. So we do believe that there's a little bit of a chance for US dollar strength into the next couple of weeks, but equally structurally, we might see the US dollar weaken over the medium term as an out 6, 9, 12 months. So again, that divergence, that volatility, it's something that's always to the forefront of our mind. And as an active manager, we do have the ability and the opportunity to hedge our currency exposures at certain points in terms of where we are in the investment cycle.
It's certainly been a question that we've received a lot recently. It's been
yeah, it's been a big impact on returns this year, the US dollar movements.
Yeah, yeah. So finally, you might give us a little bit of a short-term outlook looking ahead, given ongoing uncertainty around the policy path from central banks and the diverging economic signals. What's one key takeaway or piece of advice that Zurich would offer investors based on July's market performance?
Yeah, I think July was positive. So I think those who were in the market participated in that positivity and that move. So just to think about that a little bit, this is one of our charts of the month that we issue every month, as the name says. And if we look at the best day of the year, for positive equity markets. It was in the middle of April. And indeed, this is again to the middle of July. But just look at the difference if you just took one good day's performance out. So that would be if you stayed invested, you'd have the blue line. If you missed just one day, got out of the market for one day and then got back in, you'd be almost 5% worse off in your return. So when we see a positive month like July, it's just a little bit of a reminder that we see ups and downs, particularly, and that's why you have an active multi-asset investor to navigate those markets for you. But I think the most important thing for people is in partnership with ourselves and their financial advisors to stick with the plan and make sure that you don't miss these big days, that you are invested in markets. And again, try not to time them, but to stick with them.
Right, that's a great point, and it is very important to stick with the plan.
Absolutely.
So I'm going to move on to another segment where we discuss general investment topics. So this part of the conversation is dedicated to demystifying common investment terminology, helping both novice and experienced investors feel more confident in their understanding of financial markets. So this month, we're going to break down a term that you've probably heard us mention. We spoke earlier about duration. So what does it actually mean when we talk about the duration of a bond portfolio? Why does it matter for investors, especially in today's market?
Okay, I'll try and keep this one quick. So if we just take a particular picture, is we've already mentioned is the more duration you have, the more sensitive your bond price is to a change in interest rates. So for example, if I have a bond or a portfolio of bonds or a fund of bonds that have a duration of 5 years, if we saw a 1% change in interest rates, we might expect to see a 5% change in the price of those bonds. Okay, so the 5-year duration almost represents how much change you'll see in the bond portfolio for a 1% change in interest rates. So if I think of that, where else we could be in terms of bond durations on the chart, if we had a bond portfolio or a bond fund of 10 years in duration, that same 1% change in interest rates would change the price of that bond portfolio by 10%. Okay, so just to repeat that, a 1% change in interest rates changes a bond duration, with a portfolio with a bond duration of 5 by about 5%, and a bond portfolio with a duration of 10 by about 10%. So you could play this out down to 1 year or right out to 30 years. So the more duration you have, the more sensitive you are to interest rate changes. The less duration you have, the less sensitive you are to interest rate changes.
Okay, that's a great chart. I know that it can sound a little bit technical at first, but it's a key concept in the world of fixed income. So thank you for going through it. So I think we'll wrap up for this month, and I'll thank you, Ian, for being with us and for sharing Zurich's views on investment markets. And thank you, everyone who is tuned in. We hope you found this insightful and that you'll share this video and join us again next month. And for more details on the Zurich fund range and to download our full investment report that we produced in July, visit zurich.ie.